Hey everyone, hope you're enjoying this Friday so far. Today I'm going to go over some things that I've noticed, some patterns that I think may add up towards the end of this video. So jumping right into it, the first thing I wanted to bring up was the 10-year Treasury yield. So when I was looking up this, just I I do remember discussing this a little bit, I think last year, and I needed a refresher. So when I was looking up stuff, I came across I think a blog or an article by the US bank bond markets, and let me just read what I wrote down. So it says recently 10-year treasury yields dropped near 4%. And just to add to that, as of today, when I checked like a couple of hours ago, it was about 4.139%. So it went up a bit. And apparently, um, compared to last year, it's lower this year. And let's see here. It also says that whenever the yields fall, it reflects, it seems like the investors' expectations that the Fed will make cuts. By the way, they have a meeting next week on the 10th of December. So, based off of that, I wrote down the numbers too. So, according to, well, first of all, ChatGPT, right? Because last year, apparently the target rate was about 4.25 to 4.5. And according to bank rate, it says, because it gave like the target rate rather, of 3.75 to 4%. So it says, according to their website, um, it lines up with what ChatGPT said. A bit, actually, a bit over. Now that I look at it more, it says a year ago, according to bank rate, the rate was about 4.75. Um, and apparently this week was 4%. Now, when I checked the fedreserve.gov website, it says it was 3.89% as of December 4th. And that's the Fed funds rate, which, when I looked that up, and um, when I was doing more looking into it, according to Reuters, um, it says the Fed funds rate is what banks charge each other overnight. And let's see here. So, in another article by Yahoo Finance, it says, so just a refresher for myself too, the 10-year Treasury note is basically issued by the US Treasury. That's basically how they fund their operations. And so that whoever invests in that makes, of course, an investment and a return. And that's like a fixed rate, and they get paid for about like every 6 months. It says in the article, apparently until the term ends. And apparently, the 10-year Treasury yield kind of moves in the same direction as mortgage rates do. And it said in the article something about the margin, but of course, like this was an article I think I read like a few days ago. So because I want to be as up to date as possible, I'm just gonna stick with, okay, so based off of the information I gathered so far, It just seems like the yield, the 10-year treasury yield moved up. Therefore, what that means is there seems to be, I'm just going to say speculation that the economy is stronger, or at least there seems to be sentiment that the economy is stronger today than it was, like, let's just say the last time I read this, which was about a few days ago, or at least last week. At least a few days ago, at most last week. And it also says, because I was curious too, as I was looking at why the 10-year treasury went up recently, is because apparently, according to CNBC, they published an article, I believe, like yesterday, or like, I don't know, when I read it, it said like 15 hours ago. So rather than doing the math like now, the treasury yields, the title of the article is Treasury Yields Move Higher After Cooler PCE Inflation. I don't even remember what PCE means, but apparently the inflation measure was lower than expected. And like this is the thing though, like that type of, I don't know, for lack of a better word, reaction towards that news that there was inflation data, like when I looked into it, like the latest data is from September. So, I mean, they're responding to news from like a few months ago. And of course, like we mentioned last time, because of the government shutdown that lasted like 43 days, the other data that we should be having to make a better informed decision has not really been released yet. Actually, that's going to be released on, at least I know the jobs data, or at least this employment situation data, I think is what it's called, is going to be published on the 16th of December, which is going to be like almost a week after the Fed meet. And like I would think they kind of need that information to make a better informed decision. But you know what? I guess they were scheduled to meet that day, so they're going to do that anyway. Um, as far as, and I'm curious, like, for those of you who have businesses, I'm curious, what business are you in? And if you can add that to the chat below, that would be lovely. Okay, so let's see here. I wrote down, like, I numbered everything. I must have skipped a number. But anyway, so going back to the article I mentioned earlier about from the US bank bond markets, right? They did mention, well, the article is mostly about, the title was How Changing Interest Rates Impact the Bond Market. And that, I looked into that because as I was reading another, I guess, blog, or more like an opinion piece, it's, I think, like, it, they brought up the 10-year treasury and how that, basically how it seems like the market responded last year, according to how like the rates were being cut at that time. So here, the article, it mentions at some point how this the Trump administration has been working on like deregulatory changes. So different sectors like energy, artificial intelligence, finance, even health, and I think it was pharmaceutical because I looked that up. Let me see here. So my notes also says, according to IBIS World, which does like, seems like they do like analytics, English, analytics, statistics type of, um, I guess, articles. So it says here the key areas of deregulation. So it was more specific. So it says healthcare, specifically pharmaceutical manufacturers and distributors, energy and environmental policy, highlights fossil fuel industry, finance, like financial services. Um, and then it mentioned the weakening of the Consumer Financial Protection Bureau, CFPB, which could offer banks and credit institutions opportunities basically to, it looks like to make more money, which whenever the make, it just based off of what I was able to gather, seems like when the banks have the money, then of course that means it's easier for people to borrow money, especially business owners. So going back to the rest of my notes here. Okay, so this is based off of, I just thought this was a good thing to add to the White House published fact sheet. By the way, this stuff regarding the deregulation from both that article I just mentioned. I really don't want to, I'm not sure I want to flip pages back and forth at this point. And the White House fact sheet. So, okay, the 10 for 1 mandate. So, apparently, it requires that whenever an agency, I don't even know what that word means, but I'm just going to say whenever an agency forms a new rule, regulation, or guidance, it must identify at least 10 existing ones. And um, basically, it looks like have those repealed. And apparently, this is to help. It seems like boost, like just based off of observation here, it's meant to boost the economy in a way where it's more friendly for entrepreneurs and small businesses, and of course the whole thing that people have been talking about, the price of food lately, because it's been crazy. And I'm curious too, just based off of the information so far, do you think our economy is going in the right direction? Just because, unless um, you are new here, like I discussed in, I discussed before how, just my take on, just based off the patterns this past year, like, people talking about, for example, AI, being something that might replace jobs. And then at the same time, you see the Trump administration, like they seem to be creating this environment that's better for, um, I guess, anyone who wants to create computer chips, um, who want to manufacture cars, things like that, where I can see, on one side there could be loss. I can also see the benefits. And again, like I think I mentioned last time, um, it really has to do with the person's intentions, whoever is in charge of making those type of deals, because if their priority isn't to hire, then obviously that's when, I mean, I would not be surprised personally if, like, there would be a job cut. But if, they're really trying to benefit the economy and hire more, then that might be um, that might be a way to go about it. But, of course, time will tell because, like not trying to point any fingers. This goes with anyone. I think, like if you can talk the talk, I mean, can you walk the walk? So, and then going on to this well, they call it a note, but basically I came across, I'm just going to call it an article because I really don't know what else to call it. So it says a note on recent dynamics of consumer delinquency rates, and that was published by the Fed. So that's based off of Equifax, CCP. So I don't even know what that abbreviation means, but basically they observed like patterns, developments in credit card and auto loan delinquencies since like basically, like, I don't even like to say the word. I don't even know if I can say the word, but I think you know what I mean. The whole, the really, the time it really felt like things were really getting crazy, several years ago, um, all the way through 2025. Anyway, so according to this note, um, it says here that, like, I'm just going to go over um, just like bullet points, I guess, things that influence the delinquencies in, or rather, credit delinquency rates. So basically, um, they noticed a rise in aggregate credit card debt. So, like, I guess, like the collective whole, just probably mixed in a bunch of other factors. I don't think I saw really in the note. Probably there's probably more. Maybe I didn't read between the lines, but along with that, uh, factors such as they say laxer lending standards. Though if you owned a business and you were lending money, I'm curious if you would agree that if it was whether or not it was a lax or a strict. um, I guess from your perspective, and then like and and the bullet points I'm mentioning has to do more so with the more recent um, patterns. So they also mention like the effects of past tightening in bank credit lending standards, right? To be more specific. And let's see here. They also mentioned, well, there was like basically there were different charts though, like because I'm on my phone, I'm not really like gonna, yeah, that's a whole different thing. Anyway, but basically the graphs showed um, there were three credit score categories. So one being subprime, being less than, I'm thinking this is them referring to the credit score 620, near prime 620 to 719, and obviously prime is greater than that. So all of them showed like declines in the delinquency rates the past like third quarter. I don't really know exactly what I mean by third quarter, like when it starts, when it ends exactly, but based on the study, seems like um, the case for, so it seems to be like the credit card delinquency rates for mortgage status for homeowners and renters, and those from low to medium, they call it tracked income levels. I guess that's based off of like just what they call it in the census, having to do with the census. I don't know the exact verbiage, but basically there seems to be, again, like a decline in those delinquency rates. So just based off this observation so far, um, like, like, okay, so when I'm looking at investors' response to the PCE inflation data, and then the it looks like the consumer, the credit delinquency rates like declining. It looks like there's some hints of strength in the economy. So I don't know. Do you guys think that there will be another rate cut on the 10th? If you can add that to the comments, that'd be great. Speaking of which, like I mentioned, they have their meeting coming up on the 10th of December. So, like I mentioned before, like there just seems to be, at least for now, there seems like to be this back and forth between, different. I mean, what can I say? I listened to one video where this guy, I shouldn't call him the guy like it's casual, like I know him. What's his name? He made it was in one of my previous videos. It was recent too, but basically he mentioned something about, oh yeah, this is the same notebook I was using. Give me a moment here. Look at me trying to be as accurate as possible. This might take a while. John Williams. Okay, that's his name. So he is the president and CEO of the Federal Reserve Bank of New York. So that was, when did I do that live stream? That was on the 21st of November. So yeah, at least a couple weeks ago. Yeah, because he mentioned something about a possibility of a adjustment in the near term. And yeah, so I guess that'll be interesting to see just how people respond up until that point with the market, like what people will be willing to invest in and whatnot. Because those things are indicators of what people really feel about the economy, to my understanding. So in addition to that, let's see here. Right, there's been talks about the candidates for the next Fed chair, and I was looking up Reuters and what source is this? Fox Business. Yes, they both mentioned that right now seems like the people, I guess, that are running for this Fed chair candidacy are Fed Governor Kevin Warsh, it looks like. And I apologize if I wrote that and said that incorrectly. And then Fed Governor Christopher Waller. But as of right now, Kevin Hassett seems to be, his name seems to be in headlines, or at least the one that I found, but he seems to be getting a lot more attention than the other two. So we'll see, because it seems like Jerome Powell's, like, his time as a Fed chair will be up like in May next year, and basically, like, I don't know how much digging I want to do on Kevin Hassett, but he was a former Fed senior economist, and he's now, it looks like, the White House economic advisor. So anyway, that about sums up the stuff that I've been looking up this past week or so. Anyway, I should be back here next Friday, perhaps around the same time. We'll see, depending on how fast I can get through all this information. If I like, the whole goal is to read the right stuff, so I'm not like digging, and because once I start digging into things, I want to go deeper. But ideally, the right articles, right? So anyway, I hope you enjoy the rest of your night, and I will be back here next week. Okay, and then, of course, I don't want to leave. I shouldn't leave before doing this, of course. I just want to put a disclaimer because I did mention what, like market sentiment, like what it looks like as of recently. And so I'd rather not anyone, you know, take what I say and run with it and think of it as financial advice. So here's a disclaimer. um, of course, I am a licensed financial professional. And if you want to discuss your goals with me, you can book a call. I'll put up the link in a moment here. And of course, if you want to discuss things that go deeper than just your goals, then I am connected to other financial professionals who may be better equipped to help you. And then we can go from there. Now, here is the link that I mentioned. So I haven't really made any changes, so you can find the link on my website at dianevey.com. You can also find this Calendly link on my About Me section of my YouTube channel and on, I believe, I think actually Threads, but it should be on IG, maybe TikTok. I don't know. Maybe you can find me and find out. I'm using the same user handle. It's Diane Vey Finance, all lowercase. But anyway, I hope you have a wonderful weekend, and I will see you next time.